Welcome back, everyone. This is an update for the oil market. WTI's price was marginally higher compared to our previous report, even though not much price action has been observed lately for the commodity. However, due to the nature of the energy market constantly being affected by new data, this report aims to briefly overview some of the latest and possibly most important updates for the oil market. At the same time, we will be providing our own views through the matters discussed, with a final closing stating our personal opinion on where the oil market stands at the moment. We make a start with the weekly oil market readings from the US, as they could provide useful insights for traders looking to form decisions. During the past Friday, in the US session, we received the US Baker Hughes oil rig count, which indicated active oil rigs saw a minor reduction by one oil rig in the past week. Active oil rigs display the ongoing demand for the commodity, even though the active oil rigs in the US have been dropping for several months now. Last week's drop was the smallest we have seen in the past 3 months. Is this an indication that demand has started to stabilize? It could be. Yet, the active oil rigs remain very low at the moment, and in our view, any increase in the coming weeks could be positive news for WTI's price. Moreover, the weekly EIA crude oil inventories reading released a large drawdown of minus 7.2 million barrels, possibly favoring WTI's price. We must note that this was the largest drawdown the EIA has released since January. Furthermore, API's weekly crude oil reading was also a big drawdown at minus 8.16 million barrels, being the largest since August 2019. The significant reduction of crude oil inventories by both the EIA and the API are of course positive for oil prices, but also an indication that a rebalancing of demand and supply is taking place. Along with the US, the OPEC Plus group is also taking action to adapt to the current global oil market circumstances. Even though the global economy has started to uplift its activity, some sectors may take time to readjust to the levels seen prior to the virus outbreak. Sectors like traveling and tourism will possibly be reduced in the next months as countries are taking action to control their exposure to the virus and people may not be willing to travel. In any case, the matter significantly affects the oil market and production may continue to be lower for the following months. During June, OPEC's oil production was the lowest seen in decades as leader Saudi Arabia and other Gulf Arab members deepened their cuts, according to Reuters survey. After the latest cuts, the group's compliance to reduce supply could surpass 100%, even when other members like Iraq and Nigeria are not following up. Despite the dramatic lower production, price action for the commodity has been minor. Thus, we could say demand for oil is still reduced. Nevertheless, according to Goldman Sachs, oil demand in large economies like China and India has recovered very notably. However, the investment bank also noted that it expects the return of demand to be gradual, with an increase of approximately 6% in 2021 and to reach pre-pandemic levels by 2022. On a final note, the reduced demand for oil seems to have had a negative chain reaction on other parts of the industry. Oil refining countries that depend on importing oil may require government support in order to keep their operations going. Those were the fundamentals for the commodity. Please stay tuned for the technical analysis. Welcome back, everyone. This is our technical analysis. This is WTI 4-hour chart. WTI is currently trading just between the R1 41.50 resistance level and the S1 39 support level. We must note that on the 29th of June, the commodity had seen consecutive upward movement and broke above the $39 price and has turned it into a support line. If traders continue to buy the commodity, then the next possible stop could be the R1 41.50 resistance level, last seen on the 23rd of June, and is the highest price seen since the 6th of March. The next levels we have noted in a possible continuous upward movement are the R2 43.45 line and the R3 46.20 resistance barrier. However, if the commodity returns lower, it could initially test the S1 $39 support level that was tested on the 30th of June and the 1st of July, but was not breached, proving traders tend to keep it in mind. Yet a possible strong selling momentum could send the commodity down to the S2 37.25 level that was tested various times after the 16th of June, but was not breached. If the commodity's move lower persists, then the road could be set for the S3 34.50 line, which was last seen on the 15th of June. Please note the RSI indicator below our chart seems to be aiming for the 70 level, displaying the current bullish momentum in the latest sessions. Thank you very much for your time and enjoy solid trading.